Behind every major challenge the world faces today, climate change, inequality, aging populations, collapsing ecosystems, lies one common thread: capital allocation. My name is Kim Chimsasa, and I'm an investment actuary based in London. Every year, trillions of dollars flow through the global financial system, yet the Sustainable Development Goals financing gap now exceeds over $4 trillion annually. The way money moves determines which problems get solved and which ones get worse. But capital doesn't allocate itself. It follows assumptions about risk, return, and time. And those assumptions are often blind to the long term, and this is where actuaries step in. Despite the vast scale of global investment, too much capital is still flowing towards short-term profits and carbon-intensive assets. For example, fossil fuel subsidies are over $7 trillion globally, which is more than double the required investment in climate adaptation. On the other side of the coin, climate-related disasters displaced over 45 million people just last year alone. Actuarial models, when narrowly applied, can easily reinforce these patterns by undervaluing future risks and negative externalities. The result? Well, capital flows into assets that meet liability needs on paper, but undermine the resilience of the very society they're supposed to serve. So why actuaries? Because we are trained to think in decades, not quarters. We understand compounding of interest, yes, but also of risk, inequality, and opportunity. We don't just focus, we stress test, we challenge assumptions, and most importantly, we operate within some of the largest and most conservative financial institutions in the world: insurers, pension funds, regulators, where we influence deep capital pools and sit at the center of capital allocation decisions. Traditional definitions of fiduciary duty prioritize return maximization. But what is the value of a pension fund that delivers financial returns but funds an unlivable future for its beneficiaries? Risk is no longer just confined to volatility or credit spreads. Today, real risks are systemic: climate disruption, geopolitical instability, public health breakdowns, which are creating billions in economic losses annually. Across the world, pioneering actuaries are already making an impact. In Kenya, microinsurance schemes backed by actuarial modeling are helping smallholder farmers recover from drought. In the UK, life insurers are integrating green assets into annuity portfolios, funding clean infrastructure while meeting regulatory standards. In Southeast Asia, actuaries are collaborating with development banks to price resilience bonds for coastal cities at risk of sea level rise. These are not hypotheticals, they are the future of actuarial work, but we need to scale. And that means embedding sustainability into actuarial education and building alliances across finance, policy, and climate science. Finance has the power to decide what the future looks like, and the models we build shape the world we live in. The assumptions we make, the frameworks we apply, and the risk we acknowledge. These shape how trillions of dollars flow through the world. And that flow determines what gets built, what gets protected, and what gets left behind. As actuaries, our role is more than technical, it's moral. So let us use our seat at the table, not only to manage capital, but to direct it with conviction, with wisdom, and with purpose. Because the future is uncertain, yes, but it is also ours to model.